The United States just evacuated its embassy staff from Israel. Silver closed Friday at $94, Bitcoin is crashing, and Wall Street just had its worst month of the year. If you think those four headlines are separate stories, they are not. They are the same story. They are all pointing at the same thing. And by the end of this video, you will understand exactly what that thing is and why it should matter to every single American watching. Today is Saturday, February 28th, 2026. Markets are closed. That means you have exactly 2 days to understand what just happened before everything reopens on Monday. Stay with me. This is your complete breakdown. Let me start with the story that should be dominating every conversation in this country right now. The United States has begun amassing air and naval assets in the Middle East at a level not seen since the outset of the 2003 invasion of Iraq. That is not my opinion. That is the reporting from multiple major outlets as of this week. Here is the timeline. Since January 13th, 2026, tensions between Iran and the United States have intensified amid Iran's ongoing crackdown on nationwide protests against the Iranian government. On January 13th, Iranian officials warned they were ready for war after U.S. President Donald Trump threatened potential military action in response to the growing death toll and mass detentions linked to the protests. On January 28th, Trump declared that a massive armada is heading to Iran. Then things escalated rapidly. On February 3rd, 6 IRGC Navy gunboats attempted to stop and seize a U.S. tanker in the Strait of Hormuz. A U.S. F-35 fighter jet shot down an Iranian Shahed 139 drone approaching the aircraft carrier USS Abraham Lincoln. On February 5th, Iran's IRGC Navy announced it had seized 2 foreign oil tankers near Farsi Island in the Persian Gulf. On February 17th, Iran and the U.S. held talks in Geneva, while Tehran says it had temporarily closed the Strait of Hormuz, the narrow mouth of the Persian Gulf through which a fifth of all oil traded passes. A fifth of the world's oil supply runs through the Strait of Hormuz. Iran closed it. Even temporarily, that sends shockwaves through global energy markets and drives safe haven demand for precious metals. On February 14th, Trump stated he would dispatch a second carrier strike group, the USS Gerald R. Ford, to the Middle East. The arrival of the USS Gerald Ford and its strike group marks the largest deployment of naval assets to the region since 5 carrier battle groups assembled at the beginning of Operation Iraqi Freedom. On February 24th, it was reported that 12 F-22 fighter jets had been deployed to Avda Air Base in southern Israel, which had available hardened aircraft shelters. This was the first U.S. deployment of offensive weaponry in Israel. Let that sink in. The United States has placed offensive strike aircraft on Israeli soil for the first time in history. On February 26th, Fox News reported that the U.S. fleet headquarters in Bahrain had been reduced to fewer than 100 mission-critical personnel. Satellite photos revealed that all U.S. ships based in Bahrain had left port. Both steps had previously been taken as defensive measures in 2025 ahead of United States strikes on Iranian nuclear sites. On February 27th, the USS Gerald R. Ford was deployed off the coast of Israel. Secretary of State Marco Rubio is reportedly planning to travel to Israel on February 28th to meet with Israeli Prime Minister Benjamin Netanyahu. That is today. One Trump advisor told Axios there is a 90% chance we see kinetic action in the next few weeks. Now let me tell you why this matters for your money. Global gold prices grew given the reports of high chances of war. And where gold goes, silver follows, often even faster. In response to the heightened U.S. military presence, Iran has temporarily closed the Strait of Hormuz, one of the world's most significant oil and natural gas choke points, to conduct live-fire drills. If the Strait of Hormuz is disrupted during a military conflict, oil prices spike. When oil spikes, inflation spikes. When inflation spikes, the Federal Reserve's hands are tied. And when the Fed cannot cut rates while the economy slows, investors flood into hard assets. Gold, silver, physical metal you can hold. Silver is priced at $94.03 per ounce today, pushing further into record territory as a powerful mix of safe haven flows and surging industrial demand keeps the market pinned near the low 90s. The rally is being driven by tariff and U.S.-Iran risks on the macro side and by AI, data center, and green energy demand on the industrial side. The Iran situation is not background noise. It is the primary driver of safe haven flows into precious metals right now. And unless a deal materializes in the next 2 weeks, it could become the dominant market event of 2026. Now let me show you what is happening on the other side of the safe haven debate, because it is ugly. Bitcoin has seen a sharp sell-off since October last year when it crossed $125,000. With the downturn extending into the new year, the world's largest cryptocurrency is down 27% so far this year and has lost 50% since the October high. 50%, half its value, gone. What's strange is this. Bitcoin's 4-month slump has come at a time when, in theory, it had everything going for it. Crypto bulls have long advocated that investors treat Bitcoin as digital gold, a new safe haven investment where traders can store funds when times are tough. So now would be a logical time for a safe haven to surge. But Bitcoin is not surging, it is doing the opposite. Safe haven demand saw spot gold trading over 1% higher Monday, showing a strong divergence from Bitcoin, which has often been referred to as digital gold. Gold is above $5,200. Silver just closed at $94, and Bitcoin cannot hold $65,000. Michael Burry, the big short guy, recently wrote on his Substack that he believes gold and silver's extreme volatility in recent days is because Bitcoin bulls are selling off their metal positions to save face from crypto's slide. Think about what that means. According to one of the most famous investors in modern history, crypto investors are so desperate to cover their Bitcoin losses that they are liquidating their gold and silver positions. That created temporary selling pressure in precious metals, but it also means that once the forced selling is done, the underlying demand for physical silver reasserts itself. That is exactly what we watched happen this week as silver ran from $86 to $94. Here is why the crash is happening. Crypto is down because of 6 overlapping factors that emerged and compounded throughout February 2026. Trump's sudden 15% global tariff announcement, a collapse in U.S. tech stocks that dragged risk assets lower, record liquidations topping $256 billion in a single weekend, a structural reversal in institutional flows as Bitcoin ETFs turned net sellers, a critical technical breakdown below Bitcoin's 365-day moving average, and escalating U.S.-Iran geopolitical tensions that are pushing investors into cash and gold. In February 2025, U.S. spot Bitcoin ETFs were net buyers of 46,000 Bitcoin. In February 2026, CryptoQuant confirmed they are net sellers, a complete reversal that removes the institutional bid that had supported prices throughout 2025. The institutions that were buying Bitcoin are now selling Bitcoin. The smart money is leaving. Matt Hougan, Chief Investment Officer at Bitwise Asset Management, wrote, "This is not a bull market correction or a dip. It is a full-bore 2022-like Leonardo DiCaprio in the Revenant-style crypto winter. And where is that money going? Some of it is going to cash, some of it is going to gold, and increasingly, some of it is going to silver, because silver gives you everything Bitcoin promised: scarcity, a hedge against inflation, independence from government monetary policy. Except silver actually delivers on those promises. You cannot print more silver. You cannot hack silver. You cannot shut it down with a regulatory order. Silver is real, and right now, reality is winning." Let me show you the numbers from this week because they tell a story that mainstream financial media is barely covering. On Monday, February 23rd, silver was valued at $86.28 per ounce. By Tuesday, February 24th, silver stood at $87.87 per ounce, a 159 increase from this time yesterday, and more than a $55 rise compared with 1 year ago. By Wednesday, silver was trading above $90. As of February 27th at 5:41 p.m. ET, the live silver spot price was $94.50. That is roughly an $8 move in 5 trading days, almost 9% in 1 week. For silver, a physical commodity, that kind of velocity is exceptional. Silver spot price is trading at $92.02 per ounce, up $5.02 or 5.77% on the day, outpacing gold by a wide margin and compressing the gold-silver ratio to 57.0. The gold-to-silver ratio at 57 is historically significant. For most of the past decade, that ratio has been between 70 and 80. A ratio of 57 tells you that silver is outperforming gold. Money is rotating specifically into silver, not just precious metals broadly. The price of silver sits significantly higher than where it was in recent weeks, but still lower than the 100+ per ounce record it broke in January. Silver's all-time high was $121.67 set on January 29th. After the historic crash on January 30th, silver dropped into the 70s. It has now recovered more than $20 from those lows. The steady prices mark the 4th consecutive session of consolidation after the sharp recovery from the February low. The pattern is consolidation, followed by a breakout. We saw it this week, and the next target everyone is watching is $100. JP Morgan has already raised its year-end 2026 gold price target to $6,300 per ounce. If JP Morgan is right about gold at $6,300 and the gold-to-silver ratio holds near 57, that implies a silver price well above $100. The past year's silver rally likely stems from limited supply and growing demand from industrial and investment sectors. Here is what happened on Wall Street this week, and it connects directly to the silver story. The S&P 500 and NASDAQ finished in the red for February amid growing fears about the impact of artificial intelligence on the economy. The Dow Jones Industrial Average dropped 521.28 points, or 1.05%, to close at 48,977.92. The S&P 500 closed down 0.43% at 6,878.88, while the NASDAQ Composite lost 0.92% to settle at 22,668.21. The NASDAQ posted a decline of more than 3% in February, seeing its worst monthly performance since last March. The iShares Expanded Tech Software ETF is down nearly 10% for the month, bringing its year-to-date losses to almost 23%. Software stocks are down 23% since the start of 2026. That is not a dip. That is a sector in crisis. NVIDIA, the most valuable company in the world thanks to its place atop the AI food chain, generated a staggering $120 billion in profits last year. This includes an eye-popping $43 billion during the 3-month period ending in January, one of the strongest quarters of any business ever recorded. Investors didn't seem to care. Shares of NVIDIA fell more than 5% Thursday following the results. With a total market value of roughly $4.5 trillion, the company's one-day loss amounted to roughly $256 billion worth of market capital. $256 billion in market cap gone in a single day from the most profitable company on the planet. That tells you everything you need to know about the mood on Wall Street right now. NVIDIA's stock price decline is part of a broader phenomenon dubbed the AI scare trade that is percolating in certain corners of the stock market. Those fears were exacerbated after Jack Dorsey's fintech company Block said it's laying off more than 4,000 employees, nearly half of its workforce. Block's stock surged on the announcement. The market rewarded mass layoffs because AI made those workers replaceable. Think about the signal that sends. The S&P 500, NASDAQ Composite, and Dow Jones Industrial Average dropped sharply on Monday as investors contemplated a report from Citrini Research about how artificial intelligence could reshape the economy. In recent months, investors have become increasingly concerned that AI code generation tools will disrupt the software industry. The Citrini report extended that anxiety to multiple industries by describing a doomsday scenario in which autonomous machines bring about an economic disaster. In the fictional scenario, machines replaced human labor as AI agents became increasingly productive while never needing sleep, sick days, or health insurance. The impact was most profound among white-collar workers like accountants, lawyers, marketers, software engineers, and systems administrators. So, while economic output continued to grow on paper, white-collar unemployment spiked and consumer spending dropped sharply. That prompted companies to reduce wages for blue-collar workers and increase spending on AI agents, which created a feedback loop without breaks. That report was fictional, but the market's reaction to it was very real. Stocks fell because investors believe the scenario is plausible. Bullish investors now account for only a third, 33.2%, of those sampled by AAII, down from a recent high of 44.4%. Contrarians follow sentiment readings because excessive bullishness can signal the market may be poised to decline. Nearly half of individual investors polled by AAII described themselves as bullish as recently as January 14th. Bullish sentiment has collapsed from 49.5% to 33.2% in 6 weeks. That is fear. And when fear rises, money moves into hard assets. Now, here is the connection to silver that most people are missing. AI is destroying stock valuations while simultaneously creating physical demand for silver. Every AI data center, every GPU cluster, every server rack being built contains silver. The metal is used in electrical contacts, printed circuit boards, semiconductors, and high-performance chips. The AI revolution requires silver to function. So the same force that is crashing tech stocks is increasing demand for physical silver. That is the paradox, and silver sits right at the center of it. On top of everything else, the legal framework of American trade policy shifted fundamentally this month. The Supreme Court decided whether the International Emergency Economic Powers Act authorizes the president to impose tariffs. The answer: IEPA does not authorize the president to impose tariffs. On February 20, 2026, the court ruled 6-3 in Learning Resources Inc. versus Trump. Chief Justice John Roberts was joined by Justices Sotomayor, Kagan, Gorsuch, Barrett, and Jackson, while Justices Thomas, Kavanaugh, and Alito dissented. Those tariffs raised more than $160 billion for the federal government through February 20, 2026. $160 billion collected under a tariff regime the Supreme Court just declared illegal. President Trump, calling the ruling a disgrace, struck a defiant tone. He said he would seek to reinstate the tariffs using executive orders under a variety of legal authorities. Within hours of the Supreme Court's decision, the president issued an executive order under Section 122 of the Trade Act of 1974 and imposed a 10% tariff for a period of 150 days through July 24, 2026, effective February 24, 2026. In a swift response, Trump announced on Saturday, February 21st, an increase in global tariffs from 10% to 15%. Although President Trump invoked Section 122 of the Trade Act of 1974 to impose these tariffs, they must end in 150 days, unless Congress votes to extend them. So we now have a 150-day countdown. The tariffs expire in late July unless Congress acts. That creates 5 months of pure trade uncertainty. Now here is the part that connects directly to silver. The executive order included a long list of products that are exempt from the 10% Section 122 tariffs, including certain critical minerals, currency metals, and bullion. Silver and gold bullion are exempt. The federal government is telling you, through its own exemption list, that these metals are different. They are not being treated like consumer goods. They are being treated as strategic assets essential to national security. Silver prices extended gains, supported by strong safe haven demand amid concerns linked to the turbulence surrounding Trump's tariff policy. The rise was also supported by a weaker U.S. dollar after Trump decided to raise tariffs from 10% to 15%, a move that could signal renewed escalation in global trade tensions. Tariff chaos weakens the dollar. A weaker dollar makes silver more attractive globally. It is a self-reinforcing cycle. Uncertainty drives silver higher, which draws more attention, which brings more buyers. So here is what is on the table for March 2026, and I want you to understand why the next 30 days could be the most consequential period for silver in modern history. First, the Iran deadline. Technical discussions are set to continue in Vienna, but it is unclear whether differences can be resolved to avoid war. Another round of indirect talks ended with a mediator claiming significant progress, but still no clear evidence that either side was willing to concede enough to avoid war. A February 18th analysis in Axios said there are no signs of a breakthrough in negotiations, making war look the most likely option. If military action begins, oil spikes. If oil spikes, inflation expectations reset higher. If inflation expectations rise, the Federal Reserve cannot cut rates. If the Fed holds or raises rates while the economy slows, we get stagflation. And in stagflation, gold and silver historically outperform almost every other asset class. Second, COMEX March delivery. March is a primary delivery month for silver futures on COMEX. On Friday, February 27th, First Notice Day saw massive delivery demand against already depleted inventory. Registered silver stocks at COMEX have been declining steadily and sit near historically low levels. If March sees elevated physical delivery demand, the already stressed inventory situation could reach a critical point. Third, the tariff clock is ticking. The Section 122 tariffs expire in 150 days unless extended by Congress. That means July 24th is the deadline. Between now and then, every trade policy headline creates volatility. Every tariff adjustment impacts supply chains. Every uncertainty event drives money towards safe havens. Fourth, Bitcoin's trajectory. Most prediction markets and analysts currently assign low odds, less than 10%, to Bitcoin reclaiming $100,000 before the end of February. Instead, the consensus points toward a trading range between $64,000 and $75,000 as the market searches for a definitive bottom. If Bitcoin continues to decline into March, the rotation from crypto into physical metals will accelerate. That is additional buying pressure for silver from a source that barely existed 2 years ago. Fifth, inflation data. Stocks dropped on Friday after the latest producer price index data came in much hotter than expected, adding sticky inflation to a list of concerns that has caused market turbulence this month. Hot inflation means rate cuts get pushed back. Rate cuts getting pushed back means economic uncertainty. Economic uncertainty means safe haven demand. And safe haven demand in 2026 is flowing into gold and silver at historic rates. The year-over-year growth in U.S. margin debt exceeded the 12-month return of the S&P 500 by a substantial magnitude. The World Gold Council identifies this divergence as having occurred only 3 times in recorded market history, and each prior instance preceded a major equity bear market. For participants in the physical precious metals market, this is not a tactical signal, it is a structural alarm. When leveraged equity positions unwind, safe haven demand for physical gold and silver spikes, often violently and without warning. I want to be completely honest with you. Silver is one of the most volatile assets you can own. It dropped 31% in a single day on January 30th. It could do that again. If you cannot handle that level of volatility, this market is not for you. Nobody knows if war with Iran will happen. Nobody knows if silver will hit $100 next week or pull back to $80. Nobody knows if the tariff chaos will resolve or intensify. What we do know as of February 28, 2026 is this. The United States has its largest military deployment in the Middle East since 2003, and multiple sources say the probability of strikes on Iran is extremely high. Silver closed the week at $94 per ounce, up roughly $8 in 5 trading days. Bitcoin has lost 50% from its October high, and institutional flows have reversed from buying to selling. The stock market just had its worst month of the year as AI fears, hot inflation data, and trade uncertainty crushed sentiment. The Supreme Court struck down IEEPA tariffs, Trump immediately imposed new tariffs under Section 122, and silver bullion was specifically exempt as a strategic asset. COMEX silver inventories are at historically low levels with elevated physical delivery demand, and the gold-to-silver ratio is near 57, a level that historically signals aggressive silver outperformance. Every single one of these stories is pushing capital toward precious metals. Not one of them. All of them, simultaneously. I am not telling you to buy silver. I am not a financial advisor. But I am telling you that what is happening right now, across geopolitics, across crypto, across AI, across trade policy, is converging on one metal. And that metal is silver. March could be one of the most important months in the history of this market. I will be covering it daily. If this video opened your eyes to something you had not connected before, hit that like button. It changes who sees this. Subscribe so you do not miss Monday's update when markets reopen. Drop your answer to this question in the comments. Do you think silver crosses $100 in March? I want to hear from you. This is your market. Stay sharp. This video is for educational and entertainment purposes only. Nothing presented here is financial, investment, tax, or legal advice. All market data referenced reflects publicly available information as of February 28, 2026. Precious metals are highly volatile investments. Past performance does not guarantee future results. Please consult a qualified financial advisor before making any investment decisions. The creator of this video assumes no liability for financial decisions made based on this content.